Hey, welcome to the Gray Report. I'm your host, Spencer Gray. I'm joined by Matt Bosnagel. And if you are a multifamily investor or any kind of real estate investor, whether that's active, passive, you're in the industry, casually interested, well, this is the YouTube show and podcast designed for you, keeping you up to date and trying to make sense of what's going on in the commercial real estate markets with a specific focus on the multifamily industry. Get ready to strap in because we've got a lot of great articles and reports today, including going over some of your comments left on our YouTube channel. But we've got reports from Globe Street, BizNow, CBRE, Apartment List, and Berkadia. It's going to be a great report. Let's get into it. All right, let's bring it back in. Matt, how's it going? Good morning. How's your day been so far?
Pretty good. Wonderfully hectic as always.
Wonderfully hectic. Well, we got a lot of great reports here, and I know you were hustling to kind of put it all together, keep everybody updated.
This is hot off the presses, hot off the laser printer, as they say.
Yeah. But all really interesting, Matt. So let's just, first, I want to get into this comment from YouTube. We'll get through it quick, because I think it's a question that we've gotten a lot recently. I think it's a really good question. This is from a video we did, I think about a month ago or so. Let's look at this comment, though, from LT. So LT asks and writes, if everything is doing badly, there is no way multifamily can do well. When people lose their jobs, they are not able to pay their rent. How is that good for a multifamily owner? Now, if you want to watch the video that he's referring to, you can go to our YouTube channel, the Gray Capital YouTube channel. Make sure you subscribe. This is the how will the Fed's interest rate hike impact the multifamily market. So, Matt, let's just talk about that real quick. I mean, it's a good question. In a recession, a recession isn't good for anybody. It's not good at all. But there's a couple nuances to multifamily that make it an attractive asset class to invest in because it's relatively stable during recessions in a variety of kind of economic scenarios and situations. It's a good point, though. I mean, recessions aren't good for multifamily. Unlike inflation, where inflation can drive rents, and inflation is actually multifamily is a beneficiary to inflation, but recessions are something something different because it's a real contraction.
This is just a gut reaction, but I feel like if there's a recession, you want to look at the relative performance of a lot of places, and I feel like if there's a recession, there's not going to be a lot of apartment owners that are going to say, oh, I wish I didn't own apartments. I wish I didn't have this asset. Instead, they're gonna be thinking about the recession in general. And unless this is specifically targeted to apartments, then I don't see. Industry. And even during the great housing crisis of 2007 to 2009, it hit housing, and apartments didn't really tank either. So
they definitely decline. You saw cap rates expand and rents decline for about a year and a half, and then they started rising really quickly kind of after 2009, and cap rates recovered relatively quickly. So it's really kind of short-term pain, but that was a full-on to your point, that was a full-on housing crisis and a housing crash, a problem in real estate specifically. We're not really in that same scenario than we were back in 2006, 2007, but I think it's a good caveat to put on it that if it's led by housing, then we're talking about a little bit of a different scenario. But even in that kind of just about worst case, apartment owners that were positioned in the right way were able to get through, and some actually did really well. It was only if you were kind of over your skis, you really over levered, and you weren't kind of sticking to fundamentals, that's when some folks got in trouble. And really what was happening, a lot of the banks were in trouble. So they were going to multifamily owners, even if they weren't in default, they were trying to fix their own problems. And so they were trying to call some notes, but multifamily owners were like, no, everyth's good. We can keep paying our mortgage payment. All is good. But to your point, so there's two things to really look at. One is the relative alternatives. So where else do you go in a recession that's going to perform really well? The stock market can be incredibly volatile. Bonds aren't necessarily going to be. I mean, if you were in bonds before the lower interest rates, perhaps. But there's not most people don't think there's a whole lot of utility for bonds outside of kind of a ballast in your portfolio. And multifamily tends to get through, and if you have a long-term
You get a lump of gold, you get a bunch of gold.
For what?
You can get a bunch of gold and just invest in the gold.
Oh yeah, you can go to gold. I guess you go to Bitcoin, although gold hasn't really performed the way it's supposed to recently. It's kind of changed, and Bitcoin and cryptocurrencies have kind of been tracking other risk assets like the stock market. And the stock market tends to not do well early on in a recession.
Yeah.
So it's all relative to what other opportunities there are, and but then also look at it from an actual what's going to be going on at the properties themselves, and why is it necessarily bad for or how it could be bad for multifamily.
Mm-hmm.
And the reason is to the commenter's point, LT, that people are going to be losing their jobs. They can't pay for rent if you're losing their jobs. So what happens then? People have an alternative of when they have to go find a job, if they can find one. Maybe they're taking a lower salary, and they still need a place to live though, even if they can't find a job. So whether that they're getting help from family, or in a worst case scenario, they're moving out and they're moving back in with family, or they're moving in with their friends. They're getting roommates, and so you do see destruction of household formation, and household formation potentially even going negative, which decreases occupancy slightly. But also you're just getting a higher turnover rate because of that. People are just moving around more because someone who may have been renting a luxury apartment community may be stretching a little bit. If they lose their job, or if they have to switch jobs and they're taking a lower salary, well, housing has inelastic demand. People need a place to live, but maybe instead of paying that, call it $1,600, $2,000 per month at a luxury asset, maybe they're just going to look for a better value and move down to more like a B class asset that's charging maybe $1,000 or $1,200 a month. Now that B class asset may have previously been charging like $900. They've increased rents, but it's still relatively affordable to the individuals who are kind of moving down the income ladder. And so I think that's what's important to look at is individuals, they kind of move down the income ladder, and then they can move down in kind of class of housing in an economic downturn, and they can also move up that economic ladder in the upswing. But we'll also, what we're seeing right now is there's so many, and we're going to get to this later on, I know the Berkadia report, the apartment list report, home ownership is so unaffordable right now. And so that is allowing a lot of people with pretty good incomes to decide, I'm just going to rent right now because I'm getting sticker shock. Mortgage rates are way up. I'm going to need to rent for longer, or maybe I just rent for the foreseeable future because I can't make sense of this.
And even in this worst case scenario, in a situation where maybe apartments are hit, or maybe it's just a generalized recession, you may get less rent, but you're not going to get zero rent. Things aren't going to implode. It's not going to be a crash.
When we model it out, it's like cash flow decreases, but at least the way we look at projects, our break-even occupancy has to be so low. And keep in mind that right now we're at all-time highs in terms of occupancy. So we actually have a good amount of room to fall and still be in that normal range. I mean, a lot of markets are at kind of 97% occupied. A lot of markets before were kind of in the 94, 95%. And so if you have some of that household destruction, you're just going to be in kind of that normal band that most people were underwriting to anyway.
And I know it's hard to imagine, but I do think that recessions are limited time period events.
Oh, yeah.
They're talking about this recession like it is the threshold towards the unknown of an indefinite period when, there is something unknown about it. But one thing that I'm sure of is that if we do have a recession, we're going to come out of it, and it's not going to be that long.
And that's why it's just key to have... look at your time horizon. What's your time horizon? If you have a very short time horizon, I need to make this investment work in 2 years. Well, and maybe it doesn't because 2 years, there's a lot of things that can happen, and if you have to have something happen in the short term, versus if you're like, I'm going to give myself 5, 7, 10 years. Maybe there's a great time to sell in year 4, but if something happens in year 3 or year 4, you're not forced to do anything. You don't have a loan coming due, and you can say, I can batten down the hatches. I can wait this thing through, and then maybe in year 6 or 7. It's going to be a great time to sell. But you've got that option. You're not having the bank or someone else make that decision for you. Or you may have a long-term loan, but you've told your investors, hey, we're going to turn this thing around in 3 years. And then all of a sudden, hey, I need to wait it out until 5. investors should be okay with that.
Mm-hmm.
But it's something to keep in mind. And that's why we've stretched out our hold periods really just we're modeling for 10 years. We're not saying we 100% are going to hold this thing for 10 years. We could hold it for 4 years, 5 years. It's really until the asset stabilizes, seasons, has good cash flow. We prefer to refinance it, pull cash out, and keep holding it for a little bit longer. But there's also opportunities where it's like, look, the best, most accretive plan for this asset is to pursue a sale.
Yeah.
So, but you want to have optionality. Okay, Matt, let's get into reports. First, starting with this Globe Street article: apartment demand expected to moderate over the next decade.
So
that's something to pay attention to.
Yeah,
right?
we're talking about recessions, and I picked this article really because I've been so optimistic in the past about apartment demand and the economy, and I wonder really after reading this, what is the limit of this optimism? We've covered rapid multifamily growth throughout the pandemic, and rents have remained elevated compared to historical averages. Forecasts for 2022 predicted elevated rent growth, but it was not like last year. Maybe your favorite multifamily market had 24% rent growth last year. Maybe it's going to have 12%. That's still well above the 3 to 4%.
Still
average.
4 times the norm.
And so that's why this article got my attention. I've read so much about the massive demographic pressures that have buoyed the apartment market now and really are projected to in the future. And so housing demand looks like it's overdetermined to where it's going to be so high. We keep hearing about the housing affordability crisis, which implies that there's going to be this huge demand. But these demographics haven't always been this way, and I guess they won't always be this way. So the researcher here, finance professor Norm Miller, says that in the 2030s, demand could go down due to low population growth and low immigration. He expects, and this is a quote, a recession by 2029 or 2030 because of the federal deficit growth and growth in Social Security, Medicaid, and Medicare entitlements. So that's kind of aside a little bit and related to.
I was going to say the first comment I think has good weight and is worth paying attention to, which is the lower population growth and lower immigration. Those are two things that you really need to watch. But the recession in 2029, federal deficit, Social Security, Medicare, I mean, sure, that's possible. That's been talked about for the last 30 years also, that we're going to have a recession.
Yeah.
In predicting a recession in 2029, I just don't think, to me, I don't know. I take that with a big, hefty grain of salt and don't put that much weight on it. But, the demographics are the demographics. And we've talked about a lot in the past about how a lot of it is immigration. If you take in-migration to the United States, if that reduces any further, I mean, that's really the only thing that's kind of keeping the population of the United States growing. And so I know it's a kind of hot button political issue, but we've got a major labor shortage right now. And if people want to come here to work, come on.
I'm going to turn off some viewers by saying this, but immigrants don't always, there's no pre-planned political party that immigrants are going to come into.
Yeah.
More and more, you're seeing people that immigrate into Texas. Guess what they don't become? They're not necessarily Democrats. They become Texans.
Yeah.
So I'm just saying it's not always a pre-planned political end to these things when it comes to immigration.
I agree 100%. Again, it's unfortunate that it's so politically charged and motivated. Just a little discussion around immigration, but it's something to watch. But that's something they could turn around too.
Well, and that was my part of my defensive argument. It's like, okay, all right, this sounds bad for me. It's against my optimism. But one reason that I think that there's maybe a little bit more uncertainty when it comes to population growth is that this rise or fall of the birth rate or it could depend on a number of factors, not the least of which is the pandemic. So if you're drawing a line there based on the tumultuous years of the pandemic, I don't think that anyone can predict that. People thought there was going to be a baby boom, and really there was a mild baby bust.
Exactly, and who knows?
Yeah,
Again, who could have predicted the baby boom after World War II?
Mm-hmm.
That wasn't in the card. That wasn't like in the demographic projections at that point.
Yeah.
We don't know. But
but
the birth rate is definitely lower.
Yeah.
That's for sure. And we have an aging population. And millennials are going to be out of their kind of core apartment renting years. Although that range is spreading.
Yeah.
Millennials are being renters longer and longer. but there'll be a point where a lot of them will have bought homes.
Yeah.
And then it's going to be the Gen Z, and then the next what's the generation before? What's the next generation after Z?
I don't know. It's my kids'
Double
generation, so I should know.
Is it the iPad? That they make something.
Gen I.
Something silly.
But so that's on one side. There's a lot of different factors that go in demand in population growth specifically. And I think that there's a little bit of different political and cultural winds that could affect immigration as well.
Yeah.
So that's just one thing, and I think he has a very valid point when it comes to these broader population pressures. But I do want to say, and I mentioned this before, we got a housing affordability crisis. Yep. It costs a lot to build housing right now, and we still need to build a lot of it. I think so. I don't have a specific answer to what's going to happen in 2035 or 2030.
Yeah.
But I do think that it is worthwhile coming up with an answer to some of these ideas, not only, but also just trying to think of what would happen, what should be the best practices for multifamily investors if these things do start to happen, if demand does start to tilt to the negative. What's the best thing for multifamily investors to do?
Well, and I think a lot of it is going to be, we're talking about big national numbers,
Mm-hmm.
and so each market has its own demographic story.
Yep.
And so that's where you can still find winners that are going to be having those themes for, the foreseeable future. I mean, we're still talking about, 10 years out or more. So, who knows what will happen.
It is interesting too, because last week John Chang talked about 20 years in the future, and things seem pretty great for CRA as a whole and for multifamily. He did not say there was anything.
Now I will say though, a lot of that prediction was based. He was really using the last 20 years as an
Mm-hmm.
indicator, and I think that maybe the author of this piece, Norm Miller, may be saying, well, the demographics are different. You have the millennials coming of age and being the largest generation. And that's not going to be occurring over the next 10 years. So that's something to continue to watch for. Matt, I want to move to this BizNow article, but first I do just want to make just a quick note that if you're interested in multifamily investing, you'd like to learn more because we are getting really kind of strategic and tactical, finding out where the markets we're seeing a lot of growth that haven't been bid up. A lot of it's in the Midwest. Pop on over to gray.fund. You can put it right into your browser. It's only open to accredited investor. We have 2 multifamily projects currently under contract, over 500 units that are just going to be immediately going into the portfolio. Eventually, we're going to have over 1,000 units in this portfolio, 7 to 10 different properties, a lot of opportunities to earn passive income, get a really nice multiple on your capital. We've got a great team here at Gray Capital that's going to be managing these assets and investments. Looking forward to partnering with you. Again, hop on over to gray.fund to learn more. Okay, so BizNow, multifamily rents they're soaring, man. They're soaring. But the party could be over as salaries fall in line with pandemic migrations. A little bit more FUD for the multifamily thesis, but we're trying to be fear, uncertainty, and doubt. But we're trying to bring it to you straight and not just show you all of the kind of the good rosy opinions. Trying to be as neutral as possible, because again, we're putting our money in these deals. We want to know what the right steps are. So what is business? What's BizNow saying?
So this Globe Street article, that was going against that big narrative that I've been talking about, and I still think is valid. Those demographic shifts that are driving housing demand. Yeah. This one is kind of pushing back against that narrative that of remote work being able to really unlock some mobility and savings for a lot of renters, specifically for this article, but a lot of people in general. And it seems like the implied thesis on this article is that wages are really going to be more tied to cost of living in a specific area. Yeah. They're not going to pay you $100,000 no matter where you live, basically. And I think that there's some truth to that, but I don't think that it's going to be as strong as this article implies. I don't think that there's going to be a huge snapback in wage expectations that's more tied closely to cost of living. One, because it's just hard for me to imagine a coworker that remote works from Seattle making that much more than me just because I live in Indianapolis. Yeah. So
they talked about this on the All In podcast recently about how pre-pandemic, the kind of the competition for tech employees, for programmers, developers, it was so tight. There was this huge war for talent. Everyone was just competing on salary, and you were looking in, whether it's the Bay Area, Silicon Valley, New York, or Boston, wherever it might be, Indianapolis, and maybe not Indianapolis, but those other high paying markets.
Yeah.
But now with work from home, all of a sudden their labor pool has grown so much, and so they have so many options because they're no longer just saying, hey, you need to be here in San Francisco, you need to be ready to move and get going. They can look at someone who's living in Indianapolis or Fort Wayne or Cincinnati or Kansas City or Lansing, Michigan.
So on the flip side, there's a guy that's jealous that his work from home coworker makes more than him, and regardless of cost of living, if you're getting that pay bump for living somewhere that's higher cost of living, I feel like that's going to be some subject of jealousy.
Yeah, it's like even if the numbers are perfect. You don't have to live there, but I think what could happen is, maybe salaries are kind of pegged to, what the average cost of living is in that market to an extent, but you're going to see wages probably lower in, the Silicon Valleys, Bay Areas of the world, but increase in the kind of the Midwest, the Indianapolises, the Columbus, Ohio's, and all of those.
That's what I say. So there's that jealousy angle, and then there's also like, if I was a tech firm in Seattle, I'd be snapping up people in Cincinnati and Indianapolis and Kansas City because that's a deal. Regardless of whether I don't really care if your cost of living's lower. I'm getting a deal for your market, and the fact that it's expanded to this huge new pool of talent. That's got to be great. Yeah. Great for the individual worker, and probably great for someone that's living that wants to hire them.
Yeah, I agree. Okay, just kind of getting through these reports. CBRE, strong start to year with positive absorption and construction completions. Now, this is related to the industrial sector, talking about a lot of warehouses, distribution facilities, and I think specifically we're talking about the Midwest. That's where we're doing a lot of our investing, and there's been an incredible boom in industrial development. I mean, the cap rates have dropped significantly, increasing values. And, there's a lot of logistics hubs in the Midwest that are kind of key to this whole supply chain discussion. There's all this onshoring that's going on. And then just e-commerce has just been, it's not slowing down. It's got more legs. So what are some of these takeaways, Matt?
So my notes have I was going to do a Chicagoan accent, but I tried to practice it last night. I didn't do it. I didn't do it very well. But let's say I'm a diehard Chicago, and let's compare the Indianapolis amount of new construction coming down the pipeline with Chicago. Indianapolis has more industrial under new construction than anywhere else and the only place that really competes with it is Chicago. Other than that, Indianapolis is about double everywhere else. St. Louis,
I guess
Detroit,
Pittsburgh is, I guess, that would be the only other one, right?
Pittsburgh, the under construction.
Oh, sorry. Yeah, that's just for asking lease rents and vacancy. Yeah, Indianapolis is really pulling away in terms of under construction. I mean, 22 million square feet of industrial under construction in Indianapolis right now.
Chicago has 20 million and 20 million and a half square feet. And then the next one after that is Kansas City with about 13 million square feet. So really a huge drop off. We're talking about nearly twice its next competitor outside of Chicago.
And what's incredible is looking at the absorption as well. There's a ton that's being absorbed. I mean 3 million square feet was absorbed in so far in just the first quarter of 2022 in Indianapolis.
And
that's incredible.
And that's what I wanted to note too. It's not as if it is expensive to build these buildings. And I don't think that they're building it on a dream or just because they like Indianapolis. Maybe they have family there. No, they're building it to make money. They're building it because they probably have them pre-leased or, a really legitimate business plan that's backed up by, some solid analysis here.
Yeah.
And so we are a multifamily podcast. And I did want to, make that connection between population growth and housing demand and the kind of jobs that industrial brings.
Yeah.
I know it's kind of a hackneyed analogy, but I don't know if anyone remembers playing SimCity. But
yeah, just a little bit.
When you zone the industrial, that's when the residential comes.
You need the residential, but that's all the jobs.
Yeah, you need the industrial. Exactly. And it seems like, and this is a very a facile analogy.
It's the easiest way to get a lot of jobs.
But exactly, there's almost a bedrock of and this is as a
you just
kid
have to watch
playing
out for the pollution, so you have to put the trees. You have to line the trees in between the two. I've played a small amount of SimCity. Moved over to City Skylines.
But either way, so that's what forms my understanding here, is that there is a bedrock of employment in the industrial sector, and not necessarily, it's like a gold mine, and then you sell the gold mine will give the jobs to a bunch of people. There may be retail and commercial areas, a grocery store that serves those, but the bedrock of employment is starting with that industrial, that manufacturing, that that engine
all the
of the
ancillary
economy.
jobs that pop up around it. You got fast food, you got retail, people wanting to live
They're all
closer.
anchored,
by
really,
the jobs.
by those industrial jobs. And so when you're looking at a place like Indianapolis, who is the only close competitor to Chicago is Chicago, and Chicago's about 4 or 5 times bigger than Indianapolis. To think that there's not only going to be the jobs that come from industrial, there's going to be those ancillaries, those kind of knock-on effects of the huge communities that start forming. It's not just going to be a bunch of factory workers that are moving in. There's an entire engine to this economy that is really going to flourish.
Yeah, well, not to mention a lot of those
this
jobs are pretty decently paying. There's more automation that are being used in these facilities. More robots. You don't necessarily need as many people. But the jobs that you'll need, if those robots exist, are higher paying jobs, higher wage positions. And so maybe it's not, 1,000 per, per large warehouse. Maybe it's, dozens or hundreds, but still it's a lot of new jobs that, again, like you were just saying, leading to a lot of ancillary jobs and businesses in that area. And that's why, and one of the reasons why we're talking about this, it's one of the themes that we're kind of tracking and pursuing in the Gray Fund. We've got a project under contract right now on the far east side of Indianapolis. The reason why we are attracted to it, and a lot of the business thesis is, because of all the industrial. There's, not just on that side of town, there's 9 million square feet under construction.
And that was your answer to the worst case scenario. If there's low housing demand nationwide, you look to the markets, and you look to the markets with population growth. Well, follow the jobs.
Exactly, the job growth. The buildings, the places where the jobs would go, that infrastructure leads to the jobs, which is a leading indicator to the population and wage growth. Good thing to keep an eye out for. And Matt, I really appreciate you bringing that report to our attention. Okay, apartment list 2022 Millennial Home Ownership Report. This is a big question I've been asking because all these millennials, they're at the age where they typically would go out and buy a home, but they are looking at 5.5% to 6% mortgage rates. They're looking at housing prices higher than they have ever seen. It's looking a little salty. Renting might look a little more attractive, Matt. But what's apartment list getting at?
It's like with each passing year, an increasing share of millennial renters say they will never own a home. With each passing year, the obstacles to owning a home, especially for first-time home buyers, get bigger and bigger. Now, they've got some good graphs here that really illustrate how millennials aren't buying homes like previous generations. A huge share, nearly a quarter, don't plan on ever buying a home. You look at this, if you look at this line graph, it really is lagging behind at each stage of the life cycle, Generation X, baby boomers, and the silent generation in terms of the home ownership rates. I think the reason is the same in 2021 as in 2020 or in 2018 before the pandemic. They can't afford to buy a house right now, which is the same reason why millennials are choosing to rent indefinitely as well. And it's not necessarily that they can't budget a mortgage payment. Like I said before, it's the down payment it's that big hurdle. That first big chunk of money is really hard to it's hard to build when you're just starting out. And as home prices keep increasing, as you go up the ladder and the wall just keeps getting harder to climb.
Yeah. I mean, to come up, especially if you have to put 20% down. I mean, that's a big check that you're going to have to write, especially if you're only like late 20s, early mid 30s. That's coming up with $5,700 Now you could do an FHA loan, put up 5%, and I think a lot of people are probably looking at that. But there's some costs associated with that as well. So. But that's a big difference. 48.6% of millennials currently own a home compared to those other generations.
Now, if you scroll down, they actually compare it to the stage in the life cycle. So there they have that right there. Is if you parallel that still with, it's not as dramatic when you're going for 40-year-old millennials compared to a 40-year-old person, from Gen X or a 40-year-old baby boomer. we're still well below. But it just doesn't look as dramatic just because it's a younger generation.
Yeah, thanks for pointing that out, Matt.
I do want to say, there is a quote near the end of this report that kind of runs counter to the BizNow article. The BizNow said, yeah, maybe you're not going to get a whole cost of living bonus for living in a cheaper area. But this report from Apartment List says that one remaining opportunity for both generations is the widespread adoption of remote work, which has established itself as a permanent fixture in the post-pandemic economy. Decentralized businesses offer their employees the unique opportunity to access high-paying jobs in lower-cost parts of the country. So the jury's not out. The Apartment List is saying, it's possible to get a deal, to get a high-paying job in a low-cost place, but BizNow is saying maybe not. So
easier said than done.
Yeah.
So this is a great report, Matt. And again, I think because this all affects the margins, and this directly leads to occupancy and can further exacerbate the supply and demand balance. People just can't. 77%. In 2021, I just can't afford to buy.
What's interesting is the similarities between pre and post pandemic attitudes of millennials. It's not like there's been a sea change after the pandemic. Even in 2018, millennials were saying, "I'm not going to afford a home. I'll just rent forever."
Yeah.
And it's hard because I think that they were programmed after the housing crisis that homes aren't really the guarantee that you thought it would. No. This morning, I listened to a podcast that talked about renting the American dream.
Yeah.
So it's in the air, and it has been in the air for the past 10 years. So that's a cultural thing almost. That's going to be that's really redounded to the benefit of
I
rental.
think that's a really good point. There's one side of just can't afford it even if you want to, but then there's a whole group of saying I don't even want to.
Yeah.
And I've already made that decision. And again, looking at who has the down payment, 66% have no down payment to do it.
Yeah.
Only 16% have more than $10,000 in savings. So that's really the only group that could even consider buying a home, because even if you're using an FHA loan and putting 5% down, you're going to be needing something around $10,000, and that doesn't leave you any cash for emergencies or the hot water heater breaking or whatever might happen. So I would highly recommend signing up for the Gray Report newsletter, graycapitalllc.com, to get these reports sent to you, because there's a lot of great stuff in this Apartment List
One
report.
thing for if we're talking about housing affordability, there will be a benefit if Norm Miller is right. Housing demand goes down. It's going to make it cheaper for rentals. So maybe there will be able to buy a home if Norm Miller is right.
We shall see. Okay, this article, I wanted to tease earlier. I forgot, but Berkadia put out a report on renter income, and we teased this we put it out on our Sunday kind of recap, where we kind of send out 5 or 6 different links of what's going on, keep people up to date over the weekend. This was the most clicked on article. People are really interested in this because, as we've talked about, rent growth, the limiting factor is wage growth.
Yeah.
And if we're not seeing wage growth, like you can't necessarily, even with demand being inelastic, people are already squeezed. They're already paying more for gas, paying more for everything, food, whatever. Maybe they have to pay more rent, but man, it's hard to do. So where are wages going to grow, or how are wages going to grow? And because that can give us a little bit of an insight of maybe where rents are going to go as well, because that ceiling may be lifted.
I think that this report is great because it reveals that all of these worries about rising rents, maybe rents are flying up too fast compared to wages, they're basically unfounded. They find that wages for the average new lease signee are up about 13% year over year. And here's a real thoughtful quote, really. It says, "The relationship between rising renter incomes and rent growth is one that shouldn't be dismissed. Over the past 5 years, both rent growth and growth of renter incomes have marched in tandem with each other, save for the initial shock of the pandemic, which saw a brief dip in average reported incomes. This is important as it helps dispel a common myth that rent growth is widely outpacing wage growth, therefore creating a rent-to-income ratio imbalance." The average ratio they found was about 22%. And this number tracks throughout the country, as they suggest that wages really are tied to cost of living. So much for remote savings, I guess. But still, it means that a lot of the inflation numbers that we're seeing are not necessarily rent increases. And we talked about how a rent increase is going to be felt a lot more dramatically because it's such a larger portion of the budget.
Yeah.
But there's still room to grow when it comes to rent to income.
Yeah, I think it's death by a thousand cuts, and like, oh well, I'm paying more for these other things. It's just one last thing. I don't want to see my rent going up also, but it's really not surprising. And as we mentioned in the past, it's all kind of relative to the pricing of everything else, and shouldn't be too surprising. If everything is going up in price, you wouldn't think rents would go down or be flat. They would track, and it's just looks like we are seeing wages keeping up. And just parsing this information, it's the they're not looking at the total population of wage growth. They're looking at the new applications. People coming in and renting apartments are more well off.
Yeah.
And that's what we were talking about earlier. A lot of these people who maybe could buy a home or were close to being able to buy a home, they still want something nice. They want a nice place to live, a nice apartment, hope maybe with a little bit more space. So they're going to choose to rent for a little bit while longer.
Yeah.
Maybe going to be renters for quite a while, which will keep occupancy floating quite a bit.
Yeah. So just the stability, and it's good to take the blinders off. We've been covering these huge high rent growth numbers for 2021, and it's you take a look away from it, and a lot more has been growing alongside rent. And one of those things is wages, and that's one of the most important things, to have that income pool, because you don't want people to not afford it.
Yeah.
And so so this was really good to read.
Yep. Matt, great reports today on the Gray Report. Trying to keep everyone up to date. Again, trying to help you make some really smart and informed decisions when you're looking at a multifamily acquisition. Maybe you're looking at making an investment. So really appreciate you watching this video. Make sure you give us a comment. If you ask a good question, leave a good comment. We'll be sure to touch on it on the next episode of the Gray Report. You can find the Gray Report, directly on YouTube at the Gray Capital YouTube channel, as well as available on as a podcast. If you'd like to really stay up to date, I highly recommend signing up for the Gray Report newsletter. You can find that at graycapitalllc.com/newsletter. Don't forget to like and subscribe this video. And if you are an accredited investor, you want to really start hedging against all this inflation, being a really secure quality investment, check out the Gray Fund. Take a look at, just type in your browser, gray.fund to download the deck and to learn more. Again, that's only open to accredited investors. This isn't offered to invest. Always consult your financial advisors. But we appreciate you and looking forward to partnering with you on some of these exciting projects we have under contract. Any closing remarks, Matt? Anything else? What's
I don't have anything. This week, nothing.
Okay, there we go. Nothing going on over here. All right, everybody. Thanks again for watching. We'll see you on the next one.